Hello everybody, welcome to today's webinar, Seeking Order Amid the Industry Chaos. I'm Justin Surgeon and I'll be hosting today's session. Today's webinar will share insights found in our Applications Software Vendor Benchmark. If you'd like to learn more about this report, please reach out to myself or one of the analysts after the presentation. And before we begin, there are a few things I'd like to cover. First, I'll be recording today's session and posting it on our YouTube channel, TBR channel. We encourage you to visit this channel to watch this webinar or any of the previous webinars we've posted. Second, I will be following up with all of you via email tomorrow afternoon with the previously mentioned link to the recording, as well as with the slides from today's presentation. Finally, we welcome questions on the material we're presenting. Please send any questions you have through the Q&A function, and we will address as many as we can at the end of the session. Now I'd like to introduce our analysts presenting today. Geoff Woollacott is a principal analyst in TBR's software practice, where he oversees a syndicated research team for the software practice. Meaghan McGrath is a TBR analyst and one of the authors of TBR's Application Software Vendor Benchmark. And Kelsey is also a TBR analyst and also one of the authors of TBR's Application Software Vendor Benchmark. And with that, let me hand this over to the analysts.
Hi, as you can tell by the voice, this is Geoff speaking, and we will run through relatively quickly what we intend to cover. We'll give you a brief overview of how this fits within the baseline research streams that we do in the software and BI group. And then we'll get into the heart of the matter in terms of what has been going on in 2Q15 with regard to the application software vendor benchmark and the revenue categories for the major vendors that are in it. So when we take a look, what we have for research here, on the left-hand side, upper left, what you see are the company reports that are within the software vendor report. We also have cloud vendor reports that are a broader coverage, so we do have pieces there on the major cloud vendors, as you would expect. On the top right are the major benchmarks. The top one listed is the Application Software Vendor Benchmark that we're going through today. We also have one on infrastructure management. We split those two apart last year, given the major differences in terms of the operating dynamics and sort of industry macroeconomic pressures that are on these two different business lines. We have a BI intelligence or business intelligence software vendor benchmark, which also includes customer research, where we have a software buying behavior study that is releasing. It's in the editing cycle now. It'll be out by the end of this week. Now, what we have here, if you've been a regular listener to these, this is the way that we have disaggregated the vendors into an infrastructure management benchmark and an application vendor benchmark. So the colors that you'll see throughout the deck is the top one and the bottom two. IM-centric obviously is not included in here. Future extensions, we were literally just talking about it amongst ourselves before going live. We will be adding in some analysis around the growth rates within the subcategories of revenue we have in the benchmark, as well as some of the expense lines. On the expense lines, we have not disaggregated them for those vendors that play in both. If we try to look, say, at Salesforce revenue per rep, when the sales reps have the same, are selling both infrastructure and applications, then to disaggregate that is a level of estimation that probably isn't going to provide a lot of guidance. So we have some more aggregated views at some of the financial metrics and compares across those categories of app-centric, hardware, software, multi-line, and software multi-line is defined on this slide. Okay, so what are we looking at? What's happened or what happened in 2Q15? The biggest thing here is the license revenue declined 21.3% in 1Q15 compared to 24.1% in 2Q15. So those are pretty substantial drops. And the subscription line grew 50.8% or 46.6%, depending on the quarter. So this is the inevitable license erosion that we have been disaggregating over the course of the year within this benchmark. We feel like we have a pretty good handle on it, and hence why we're going to extend our analysis further into these groups. This was the most important thing to keep track of. We're pretty confident in our analysis here, and the charts that you'll see in a few minutes corroborate that statement. Secondly, the app-centric firms are showing the greatest aggregate performance as they did not have the auxiliary businesses to protect. And what we mean by that is if you have a legacy software practice, you're as much concerned with managing that erosion as you are with necessarily growing the cloud. So you have at least some internal conflict as to which do you push. Do you go renew them on the license if you can, or do you encourage them to move over to a SaaS or a subscription-based move? And this is one of the key things there. Do you have something you want to add, Meaghan?
Yeah, and so to just add on to that, I think it's important. So not only do they have to do some of the more traditional vendors have to balance both their legacy license base and their emerging cloud subscription base, but they also have to protect non-application business segments. So the bigger vendors such as Oracle, Microsoft, IBM, they all have to balance what they're doing not only in the application space across both on-premise and in the cloud, but they have to take into consideration how that ties into and affects both their, what we consider infrastructure management, so their database, middleware businesses, as well as their hardware businesses. So I think it's important to note that in that respect, they also have a much broader portfolio that they have to tend to.
As well as the impact on some of their services businesses, because not having as many of the large-scale traditional on-prem deployments has also impacted, consulting and integration engagements for those companies as well.
Right. And then what we have here is a third bullet is the disruptive forces for inorganic growth initiatives for speeding time to market. A classic example here is the flurry of activity you're seeing, say, with IBM, where they're picking up tuck-in acquisition assets where the IP is solid and strong, proven, tested, the proof of concepts are up, there's live installations, and it plugs in nicely to the broader portfolio that they can then, IBM can then scale across their broader infrastructure. By that I mean the sales, marketing, and services teams rather than necessarily infrastructure software when I say infrastructure. And there's a need for that to get to the speed to market, number one, and number two, the need to have your applications be more and more niche specific to actual vertical industry use cases. So you show the immediate value of the portfolio by the vertical orientation of the outputs. So those are the overarching themes. Then what we have when we have three key topics that we address after running through the numbers. So that slide you were just on, we have numbers and bubble charts we'll be going through. These are the scenario topics that we have for this quarter. Tailoring solutions to highly regulated, helps app vendors meet the needs of the outcome buyers. This is clearly the area where regulation is one of those things where there's a need for compliance, there's a need for rapid reaction in the event there's a change coming from these external forces doing the governance and oversight of the industry. So as a result, financial services and healthcare typically are two areas that receive a lot of attention and focus. It's no coincidence that when Watson was rolled out, the first use case was for healthcare and the second was for financial services. The second topic we have is cloud technology requiring IT skilling and reorganizations. The app vendors, in order to scale, need to lean on SIs for the market evangelism and education. And at this point in time, we see the role of the value of the system integrator as somewhat, if you think of a pendulum swing where they had to be either vendor agnostic or not, the SI is back in very much of a driver's seat. The platform and technology vendors need those SIs to go in and do those transformation engagements that prove the value of what new IT, the third platform, however you want to define the cloud-enabled world that we're slowly stepping into. There's a need now more than ever for the SIs for that account retention and education. And then lastly, as the business models mature around this, there's going to be, and we're in the process of a radical sales transformation on how you sell. Blue suit sales is not affordable as much anymore as more and more of the people or end customers prefer to do their own research, do it sort of an add to cart upselling to an existing subscription, rather than deal with the silver tongued devil who comes in and then wheels in the SE with the subject matter expert. Today, where they'd much prefer to do their own research on online ordering and online portals, and then perhaps put in a question to a subject matter expert at their own leisure rather than being heavily sold by the direct teams. So now we'll move into some of the revenue forecasts and statistics that we have. So what this has here is the estimated application revenue, profitability, and year-to-year revenue growth. So what you can see here is the op margin was 7.2% for the basket that we have addressed, and the application revenue growth for this quarter was 1%. Now, we're going to disaggregate that a little further, but here's where, Meaghan, do you have comments here? Kelsey has comments.
Kelsey's going to lead off.
Kelsey's got the lead.
So as you can see on here, we have that box kind of pointing to Salesforce, talking about how they're validating the SaaS business model. So what we mean by that is, you know, up to this point, the pure play SaaS vendors really have not been able to turn a profit. 2Q15 was the first quarter that Salesforce did achieve an organic profit, and I say organic because last quarter, if you look at their income statement, they did have a operating profit, but that was due to benefits they received from a lease abandonment, so kind of not really counting that. But this quarter, they were able to control their sales and marketing expenses enough, dropping that expense below 50% of revenue, which typically, I don't know if I want to call it a challenge for them, but it was something they had chosen not to do. And sales and marketing has always been their largest expense, and what we believe has really kept them from obtaining profitability in the past. Again, this is the first quarter. It was a small profit, so we'll see if they can keep that going moving forward. It could definitely be a fluke. But I think that profitability for Salesforce is almost like a message to the other vendors in the cloud space. Salesforce has been around for more than 15 years now. In the beginning, it was able to inconsistently turn a profit in the first few years, but was unable to achieve a profit at all since 2010. So this just goes to show, you know, some of the other vendors, like the pure plays such as NetSuite or Workday, that it may be a long road ahead before they achieve profitability.
Yeah, and this is Meaghan, just extending a little bit on what Kelsey highlighted. So that really goes to show that we've seen a lot of the cloud native vendors struggling. I mean, in their first few quarters, many of them do turn a profit, and that's just because of the lack of expenses that they're putting forth into their sales and marketing and G&A. They have very small workforces, and they really, their initial sales are more of what falls into their lap rather than what they're really, I think, going out and spending a lot of money to get. And that we see that taper off pretty quickly, and a lot of the cloud vendors operate at a loss for a significant amount of time, that being years. And I think if we extend this down into sort of the traditional vendors and multi-line firms that are moving from their highly profitable licensed software base, moving that to the cloud, this is very indicative of the challenges that they're going to face over, it might not be the same 10, 15 years that these cloud vendors face the challenges of operating at a loss. But at least for a few years, these traditional vendors their financial performance will definitely be negatively impacted by the migration to cloud. And that really is just because of the size of their workforces and the amount of money they are used to reinvesting in their operating activities. They're really going to have to either scale that down in the near term or recognize a loss as the ratable revenue doesn't quite meet what they're spending to sell those initial subscription contracts. So I think that looking at the cloud businesses that don't have those auxiliary business units or the legacy license base to offset the operating losses, they're a very good example of what the larger vendors' cloud segment or cloud business units will be doing for the next few years.
Okay, with that, let's get into taking a look at the product revenue. This is a quick slide because we disaggregate this into the license and subscription trajectories that you see. So in aggregate, The growth for this area for the second quarter was 1.5%. So, but that is a very misleading story. But what you can see here is the high flyers are in the upper right. They don't have a lot of license revenue, so this is largely reflective of what they've been doing in terms of their subscription revenue. And you can see the slow kind of migration left with Microsoft in the negative area, but they're in the negative area more so because they've had greater success in accelerating the subscription revenue than some of the others, because these were the more end user or consumerized apps, for lack of a better word, and the migration from Office 365, rather than trying to do wholesale transformations and rip and replaces of Oracle database to an Oracle Cloud Platform or SAP up over to HANA. So if we can take, is there anything you folks want to add before we jump? Okay, let's jump over to the license revenue. So here you can see 24% shrinkage in the license revenue year over year for the quarter. Again, you see Microsoft is over there, SAP is there as well. With this, I'll turn it over. Kelsey, you want to go?
Yeah, so I think probably the most interesting thing to look at on this graph is to the left of the y-axis, so the negative license growth we have here. If you look at that red line, that's our average line. Looking at the left-hand side of that, as Geoff mentioned, we have some of the more consumerized vendors, looking specifically at Adobe with their Creative Suite, and then Microsoft with Office. So they are able to cannibalize these products more quickly, and thus license revenue is declining at a faster rate than some of their peers. Also on the same side of this line, we have the vendors that have been negatively impacted by TBR's conversion from local currency to US dollars, pointing specifically at SAP, TOTUS, and then Software AG, which actually does fall on the right side of the line, but nonetheless the reason for their large negative decline there. And then on the right side of that red average line, we have some of the multi-line vendors that are actively transitioning those portfolios to the cloud, but those portfolios are more enterprise or business-oriented than the consumer ones of Microsoft and Adobe. So while it's clearly cannibalizing traditional software, it's not at the same pace, I think, as consumerized software.
Yeah.
Okay.
And I think one other thing to note on this slide before we move on is the clear separation of Splunk and Tableau to the upper right. And they're definitely located up there because they are younger vendors and they don't have the legacy license base that the other vendors are eroding in the migration to cloud. Splunk and Tableau are very different in the fact that they only have license and maintenance, as we'll discuss later, but they only have these customer bases as an alternative to cloud as they are signing on customers from the get-go. It's not that they used to offer only licenses and now they're flipping all their customers to the cloud, so they're eroding that license base. I'm talking in very broad terms here, but all of their growth is from, for the most part, new customers rather than eroding their own customer bases.
Okay. Now, the subscription side clearly shows a different story when you have a 46.6% year-over-year quarterly growth rate. You see there's the big dog in the hunt in Salesforce, obviously. Microsoft has a fair amount that's going on with it as well. So this is where you can see some of these pure plays are still doing pretty well on the subscription growth, and we inserted the table in the lower left that provides some context in terms of the absolute dollars we're talking about for the top 4 providers on this space.
Yeah, so what that table in the lower left shows is that while Salesforce is really the example in the application subscription revenue, we're really seeing Microsoft and Adobe and SAP to a lesser extent, exactly. As Kelsey mentioned on an earlier slide, SAP's performance in U.S. dollars is heavily impacted by TBR's own conversion of their euro performance to U.S. dollars. So that table shows a little less than $3 million in growth year to year. It would probably be more than that in a more fair conversion. But for even just looking at the top three, you can see that Microsoft and Adobe in real dollars are growing faster than Salesforce. So competitors are really chasing Salesforce as the giant in the market, and they're making up some of the gap there.
So with that, we'll move over to the maintenance side. As you can see, the growth rate is staying right around the average for the basket. It's a single-digit 1% growth. And there's several different things that are going on with that. Clearly, some of it is the decline in the license base. There's that 12-month lag, as we've discussed in prior iterations. The Splunk we have there is a rapid customer base acquisition, so with that, they're picking up the maintenance streams. But what we expect to see over time is that maintenance will continue to be a very slow growth or declining business segment as more and more of the customer consumption patterns move over to subscriptions. Ultimately, we will expect to see within subscriptions a sort of tiering or different subscription offers that will have with that premium different service levels. We haven't determined yet at TBR whether we're going to start trying to disaggregate some pieces of that, but we will expect to see some services tiering baked into subscription offers as we move forward as a way to cut some of the expenses to these things. If somebody just needs a 5-day, 8-hour coverage rather than 24/7 coverage, they may indeed start to dial back and start tiering that. For now, it's not mature enough for it, but we'll expect to see that coming on. Is there any comments you folks want to add here? Okay, moving to professional services. This one has a lot of different things at play, obviously. One of them is the greater the services automation that you bake into your software, the shorter the length of a professional services engagement to migrate up and over to a cloud-based application if you're ripping and replacing from a legacy. So you have you've got the shorter deal cycles. You have the shorter contract value lengths. So these are two core pressures that are hitting on the professional services space.
Yeah, and Geoff mentioned it in the intro, I think, a few minutes ago, and Meaghan will probably go into a little more detail about it later. But the other thing we're seeing is that systems integrators are taking a larger role as customers more frequently look to these firms for support as they move to cloud or, creating hybrid IT scenarios. And customers are really looking to anyone they see as a trusted advisor, whether it be the vendor or the systems integrators. They're looking for more specific expertise. So one trend that's kind of popping up is that some of the large CNSI firms are acquiring vendor-focused consulting firms or business units. For example, Accenture acquired a UK-based Salesforce-focused consulting firm called Tequila in May. They also acquired, more recently, Cloud Sherpas, which does a ton of business around Salesforce and Google and ServiceNow. CSC also acquired Fruition Partners, which is the largest dedicated ServiceNow integrator, so that's more on the IM side. But then, a bunch of different firms like KPMG and Hewitt and Mercer, to name a few of them, all have acquired around Workday. So as customers look more to these CNSIs, for vendor-specific services, this obviously is taking some of the revenue opportunities away from the vendors that we cover here from their own services arms, which, I think in a lot of cases, some of the vendors are okay with. Workday particularly, I know they would rather have their partners kind of handle the services aspect for them. But then, there's the exceptions like Salesforce. Their situation is a little bit different than maybe some of their pure play peers, because Salesforce really wants to turn into more of a trusted advisor. They've said that before. They want to be an advisor to their customers, but they've lacked the consulting expertise in-house to really execute on that strategy. So in the last few months, we've seen Salesforce now make 2 consulting-related acquisitions. First being Carenson Consulting, which is based out of France, and the second was AKTA. And, I think it's more important for Salesforce that they keep services as a revenue contributor, maybe not so much as a growth driver, but rather than looking at it as a need-to-have function of their business, like some of their peers, they're really trying to move more into a strategic advisory role. So we may start to see professional services as a percentage of revenue increase a little bit for vendors like Salesforce, while it still decreases for peers like Workday. I think it's going to be a little bit of a mixed bag.
Right. That activity with the leading SIs, I'm thinking of Accenture and Cloud Sherpas,
Yep.
is that need to build out the competencies. Again, think of the way I talked about IBM tuck-in acquisitions to scale. There's a different set of skills and technology layers required for native cloud integrations rather than the traditional on-prem type of customization work that was the bread and butter of these legacy SIs. So they, too, are seeking to adapt by buying the people assets quickly to infuse into their operations and then scale by sort of train-the-trainer best practices going out through these organizations. So there is a lot going on within the professional services space in general. And with that, we'll move now to the main key topics. The first one being the tailoring solutions to highly regulated industries helps app vendors meet the needs of the outcome buyers. And that one is Kelsey.
Thanks, Geoff. So I think there's a couple different factors that are driving the increasing verticalization of applications. First being that the U.S. enterprise application market is saturating. There's fewer revenue opportunities because a lot of the largest companies likely already have their applications environment set. If they're looking to move to another alternative or to cloud, they really need to justify the business case for doing so. And in that same vein, I think the second aspect here is that because customers need to justify that business case, they're looking more and more for their applications to deliver outcomes directly tailored to their specific business challenges and needs. So to address both of these factors, we're seeing vendors tailoring solutions to industries. And I think the biggest investment right now from vendors is in some of the more highly regulated industries like healthcare, government, or financial services. These are the industries that are most likely still using legacy systems because the cost and the risk of migrating to maybe a cloud-based alternative is often greater due to regulations. So obviously in these cases, security and compliance become important criteria for vendors to consider when developing industry applications. So looking at a few vendor examples, I think Workday here is kind of a classic case. They're taking existing strengths in human resources and financial management and making small tweaks or functionality additions to make these capabilities solve industry-specific challenges. And because Workday's strengths are in human capital, they tend to stick to more human-centric or services-oriented industries when tailoring their portfolios. So recently, they took their procurement offering and added a few healthcare-specific features while at the same time launching a new inventory application that helps address needs and regulations specific to healthcare supply chain vendors. This, I think, was their probably second real go at an industry portfolio, with Workday Student being their first attempt. Has been successful thus far. And then they also have professional services automation, which could go have a little bit of an industry flair there. And then second, there's Salesforce, who has done a lot of industry customization over the last few years after they formalized an industry business unit. So they have industry suites around financial services, healthcare, and government, among others that, similar to Workday, just take Salesforce's existing capabilities and update them a little bit to fit specific needs of these verticals. But I think the more interesting thing that they're doing around industries is adding services to their PaaS offering that enable developers to build industry-specific applications on their platform. So they just launched Shield, which is a set of security services that include encryption, auditing, archiving, and monitoring for applications that are built on the Salesforce platform. So we're expecting that Shield is going to help Salesforce increase traction in some of the regulation-heavy industries because it's going to add a layer of security to the applications that these organizations in these industries may build on Salesforce's platform. You know, a lot of times they may be company-specific extensions to some of Salesforce's core applications or custom applications used internally within that company, but Shield will theoretically allow them to build those applications while still meeting industry regulations and standards. So with that, I'm going to hand it over to Meaghan to go over the next topic.
Yeah, and so thanks, Kelsey. So we're going to go into a little bit more about what's going on from a services and partner perspective. I know throughout the bubble graphs and even throughout Kelsey's scenario, we have discussed a lot of the sort of the acquisitions around dedicated services teams and things like that. So we'll go to the next slide and we'll just dive a little bit more into the more traditional vendors and what they're doing with their partner ecosystems. So as cloud continues to emerge and really the born on the cloud vendors seek to differentiate from what they want to position as the inferior moving to the cloud vendors, so those that weren't born on the cloud but that are moving their traditionally on-premise solutions to the cloud, we're seeing that customers are becoming more and more uncertain about what is truly the right choice for them, be it a Salesforce application or an Oracle application or a Workday HCM application. They're really looking to find out what is the best choice for them. And we're also seeing that as they fold in cloud, that their environments are becoming more complex amid this hybrid adoption. So as a result, many vendors, specifically traditional ones, are looking to SI and consulting partners to do many different things. Among those, they're looking for these service partners to champion their cloud services over those born on the cloud and other competing services. They're looking to them to help shape their market perception around these new emerging business units that aren't their traditional focus. They're looking for help for services vendors to act as an impartial, or what would appear to customers as an impartial third party during the customer evaluation stages, and really support customers through their migration from on-premise to cloud solutions or in just the deployment of cloud solutions to really ease what they are seeing as traditional pain points in other customer deployments. So within that, we'll look at a couple different things that are happening in the market that we're seeing across different traditional vendors. One of those is Oracle. Oracle recently partnered or extended their partnership with Accenture to really focus on giving customers very client-specific deployment management roadmaps that will ease those customer concerns and pain points that we talked about, and really, at the end of the day, persuade more businesses to migrate to the cloud because it will be easier with Accenture's expertise and hand-holding, if you will, throughout the process. This is in addition to many vendors they're really leveraging their partner networks to promote and support the implementation of their cloud solutions to make the migration as easy as possible. SAP, on the other hand, is taking a little bit, they're not taking a different approach, but I think there's something that's more worthy of being highlighted. What's going on with SAP is they're in a transition, but during their transition, they really are looking to transform their market perception. Historically, I would say, they've sort of been seen as a complex vendor to work with, and they're using their partners to really overwrite that market perception and reform it into that of a vendor that's really easy to work with, and this goes in hand with them pushing their S/4HANA platform and really moving further into the SMB market. A very different approach from SAP and Oracle, looking to outside services providers to support their own customers' migration and adoption, is IBM, who has a very large in-house services arm that's really looked to champion its own cloud solutions. Yes, it does support the migration and deployment of other cloud solutions, but primarily of its own, and really help customers with a step-by-step deployment roadmap through the services-led approach where they're the experts of their own software. So that's similar to what Oracle is doing through its partnership with Accenture, but on IBM's side, it's an in-house services arm, so it is very deeply integrated with the software itself.
Right, and with the IBM piece, the thing that's interesting is that while they're building out, they announced the cognitive, it's not called a unit, it was a solutions group, I think, but it's the 2,000 global bodies. It's sort of a virtual organization that have the familiarity with the Watson technology, and now it's that effort to better commercialize it into the industry-specific use cases. So they've got these commercial bets they've been making. I was talking about the tuck-in acquisitions earlier, that move they made around Watson Health. It was like, I think it was last quarter, or maybe like April, something like that, where they're making some big investments, as only somebody of IBM's scale can do, to bring in this niche IP or niche professional services frameworks, because the frameworks of how you organize your bodies are as valuable and as important to your profitability and the business outcomes that get delivered to the customers as the people themselves. So they're buying these frameworks, these IP assets, as well as the human resources in these tuck-in acquisitions to better scale these operations. But they also have to keep them slightly separate at times, given the fundamental difference in a native cloud implementation versus a traditional on-premise, will customize the code type of professional services engagement that we've seen for years, that are slowly going away as the core application layers are going to have the quote-unquote one version of the truth and a continuous update cycle. Mm-hmm. That changes the way in which SI work can be performed, and all of these vendors have to try to tuck that in while preserving, to Meaghan's point earlier, preserving the legacy of the core, which is their traditional work. Mm-hmm. So with that, we'll jump into the last one, which I'm covering, which is just blue suit selling and the need to get that transformed. So if we can get into the detailed slide here. So what do we know? What's going on? Right now, what you've had for at least the last couple of years is that odd dynamic for a direct sales rep who is probably much more comfortable with transactional selling, of going and selling them the license upgrade, or going and selling the license and then getting out of there. Not necessarily, if it was shelfware, it wasn't that big of a deal, that they got it sold. And the problem has been, or the challenge has been for these direct reps, is there's a revenue compression of 3-to-1 from license to subscription. So the $1 million license sale really turns into a $333,000 subscription on average. So they're out there, and they may be trying to lead with license, or they're or say in Oracle's case, they're missionary selling the value of cloud and trying to get them to go to the cloud. But if they don't want to go to the cloud, they'll sell them the license. So you have all of this transformation that's going on. But at the end of the day, we know most of this is going to move over into a subscription basis. And the key to subscriptions is the shift from a transactional selling approach to a high-touch customer lifecycle engagement approach. It's more of a circular. You give them freeware, then they buy, then you upsell them, and you hear all these folks in their earnings calls talking about the increase in the renewal, that they renewed their top. Red Hat will talk about, we renewed the top 100 customers, and the average contract value, moved to 115%. That's showing the upsell. If you think of it, the only way you recognize revenue in the subscription model is if you activate shelfware and actually get them to use it. Hey, you're using these 2 modules. Do you realize if you subscribe to this module, this is what it can do for you and help you with your business? You've got to have that proof of concept in advance of the sale. These are all the things that are sort of upended the direct sales motion. So for these firms and for the cloud firms, if you're building out this sales competency for this missionary and very delicate sale as it's migrating from the old world order into the new world order, but once you get them over to the new world order, you're not going to need the direct reps as much as you used to in the past because you're going to have this continuous life cycle. So there's going to be a need to reduce the amount you have in what I'll call traditional blue suit selling. There was a brief, I believe it was at IBM, talking about analytics build marketing engines that really kind of replace that direct sales role. You'll have the analytics traffic of how are they using the subscription. They've got these 2 modules that they've bought. We see a user who's using these 2 extensively. They'd be a likely candidate to want to use the 3rd module. And the analytics will marry up a proactive sales rep, who really is more like what I used to know back when I sold as the SE, the systems engineer, the free technical expert that the direct rep could cart out to talk about the product. That's now your inside sales rep who's a specialist on a module. Based on the analytics traffic, they will be triggered on who it is they are supposed to go to sell or to talk to. And that's a little bit different. And the other thing that they're talking about adding is being able to marry the right persona. That if you know it's a 56-year-old grumpy old man who's using it, then put somebody on who's more mature. If it's a younger, more progressive software developer in their late 20s or early 30s, put a younger sales rep on with them. So there's also the persona mapping that can go on in these things rather than that traditional knock on the door and call. So what are the vendor developments that we've seen around this? I spoke to you about IBM and the automated analytics to match it. Oracle has had a lot of investment. They talk about it, about their sales pillars. And what they're doing there is these very targeted sales reps to go out, to go after specific cloud subscriptions with the Oracle Cloud offers to make sure that these cloud pillars take out those vendors that they have in their sites. And it's no surprise. They talk about Salesforce and Workday quite often in their analyst calls on that. Salesforce is leveraging partners to control the sales and marketing spend, but the consulting initiatives are where they're going to have some pressure on their margins. But they, too, are trying to move into this broader type of discussion. And with that, we've pretty much concluded the planned piece of the event. We'll now open it up for any questions. We have a couple that have come in, but by all means, send them through. If we're not able to field them, we'll get your name and try to respond as we can.
All right, so just a reminder, please send any questions you have through the Q&A function, preferably not the chat function. It's easier for us to read here. So, all right, our first question, how do you see performance split by geographic regions?
Well, that's an interesting piece that we endeavor to cover in the full report to the subscribers. What we've been doing is tracking the macroeconomic performance across the three major regions of the Americas, EMEA, and APJ. And what we have been finding is that the Americas region, at least at this point in time, is the one that's carrying the bulk of the growth, while APJ and EMEA are typically flat or declining over the last couple of quarters. The reasons for it are somewhat different. They're largely macroeconomic. Within APJ, a big piece of that is China. China's got a lot of the Wall Street folks concerned, given that it's really two different economies melded together. There's their export economy, given how tightly controlled the economies are by the government over there. There's the export economy. We all know how well that flies. And then there's the consumer economy. And the consumer economy has been stalling, as we know, from the cratering of their stock markets, number one. But number two has been some of that consumer economy was being triggered by government spend to build out infrastructure, and they had backed away from that a couple of years back, still promising 7.5% GDP growth to the populace. And the fear they have now is that the GDP growth is going to stall and the populace is going to be less than thrilled with the stalling. So they seem to be reverting back to a kind of a deficit spend mentality for jobs creation and just economic activity, and has a lot of folks concerned. On top of that, you have the way in which they're taking a more activist role in what is going on for technology innovation and development, the need for the partnerships in order for permission to play within China. So while the vendors are all concerned about it, everybody still seems to be focusing on it. On the EMEA side, it's a little bit different in the sense that you've got this almost 50-year experiment with the European community integration, and a key part of that tie was a single currency for the 20-odd nation states that are involved. And if you tie the common currency, you're taking away one of the macroeconomic levers to take a look at it. So we're not. That one is harder to track because there's still these competing influences of the smaller nation states that comprise the EMEA market. But there's a lot of instability in those two as a steady state. Now take technology, and where does it typically reside? If you're in the middle of these massive transformations, a lot of those experiments and proof of concept tests are going to get started closer to headquarters, and headquarters more often than not is in the United States. So that could be why we're seeing the America staying strong now, even though our GDP growth hasn't really been that fantastic since 08 or 09. But at least as far as innovation goes, either for the cost takeout, which is one of the things, or the compelling argument that started with the cloud, or for the innovation around digital business models and different modes of generating revenue for the firm enabled by technology, that a lot of these concepts would start in the U.S. and then export, and probably export sooner to EMEA necessarily than APJ, because they're both sort of the mature economies where you've got more of this legacy investment. So that's kind of how we see it. Meaghan, you've been nodding. You have something to add? Or?
Yeah, and so building on that as sort of a lot of the firms, at least that we evaluate in this benchmark, being based in the U.S., we see that really as the test bed for a lot of the new applications, a lot of the BI stuff, some of the cloud solutions. A lot of those guys are based here, with the exception, I mean, SAP is based in Europe, and that is the exception to the rule, but very much so the U.S. being the test bed and the largest market. And then on the other end of the spectrum, APAC really being where all the newer investments are going, where there will be growth in the future. It's a much smaller revenue base for a lot of the companies, and so as we see them investing more and gaining more traction in those regions, with the help of partners, we'll see that growth sort of explode.
And I do want to just jump in on somewhat the contrary to what Meaghan and Geoff were just saying. While most of the development and innovation is going on in the U.S., we do see vendors like SAP kind of taking the opposite approach, where they just launched a China-specific SME front office solution. A lot of that functionality is around e-commerce. It was developed in China, and it's just for China SMBs. But what I think is interesting there is that the e-commerce market in China, I think, is booming, more so than maybe a lot of the countries in Europe. We probably do rival it here in the U.S., but I think e-commerce is a huge part of the China's economy. So I think what we're going to see moving forward, and what I'm paying attention to, is e-commerce vendors doing a lot of their innovation and development in China, similar to what SAP has done.
Would you say that Alibaba is really leading that front? Is that where you're going with that?
Yeah.
I think the irony in all that is that the China-specific solution for SAP is named SAP Anywhere.
Yeah, that gets me every time. But again, to my point, I think none of these U.S. vendors are going to be able to go at that innovation in China alone. Partners are actually necessary for international vendors to come into China. So SAP is using China Telecom as a partner for the distribution and selling of that, but they do have an R&D center there where they've used that to develop other SME solutions. So kind of using resources already available.
Right. The China parent corporation is the main distribution arm for the technology layer that they're putting up for SAP anywhere in that regard.
Yeah, and we're seeing that across a lot of the sort of emerging BI vendors too, using the local powerhouses to really expand.
It's a necessity in China and more of a, not a requirement in Europe, but it definitely helps get your foot in the door.
Well, there's a need for the local presence. While we're sort of rambling now, we're in the Q&A section. Hopefully, you guys can stay along with us. If you do need to drop, please fill out the survey in terms of what you like or don't like. We want to hear from you so we can improve the product. But one of those things is this local kind of cultural connection, and what it makes me think of is the IBM Bluemix garages, which in my kind of aging head reminds me a lot of what Radio Shack stores were for the first guys that were building PCs and those kinds of things. Is the Bluemix garages are there. If you're having a problem in some sort of agile development methodology mode, they're setting these centers. The way IBM has stated it is they're installing this capability, or this not a retail storefront, but the ability to walk into an IBM location and speak to an IBM expert. And they're investing in these garages where they say they cover about 80% of the programming talent in the globe. So that's a place where IBM is big enough to go small on this global level, have that cultural front end, if you will, to socialize the technology with the local buyers and users in a way that I think is going to be very important and powerful for them. Now, we've got a few more minutes. What other questions do we have?
All right, I think we got time for one more here. What's your assessment of the Dell EMC merger?
Well, what's the other one? You said we had two?
Yep, the other one is what % of apps will be subscription versus license at the end of the day?
Okay, well, why don't we'll take the subscription apps one. I mean,
sure,
I don't know how.
That's more related to the webinar, I guess.
Well, subscription apps, we had this question actually come to us in the infrastructure management benchmark as well. It's like, how far do we see this rolling? It's hard to say where it'll stop. I mean, as I said, with subscriptions, we expect to see some tiering to add different response time levels into a base. So you'll have the base subscription, perhaps, and then you'll get different support tiers. But I think it's safe to say that within the next 5 years, you'll wind up with about half of the app revenue at least being on the cloud. I don't know.
I think
everybody have their collective opinion.
Yeah, I think I'm a little more bullish on the extent to which subscription will overtake license.
Okay.
I think it's undoubtedly going to be more than half of at least contracts, so not necessarily revenue dollars, but at least the engagement with customers. I think at least half is going to move to a subscription basis. As I said, I'm a little more, I think it's going to be probably a little more than others would say. I think it's safe to say maybe 80%. At the very end of the day. I mean, that's not this year, that's not next year, that's not 5 years from now.
Right.
But I think at the end of the day, there's so many more appealing things to the cloud subscription model for customers. Obviously, there's all the financial hurdles that the vendors have to sort of get over, but I think from a customer's perspective, there's so much more that is appealing about the cloud model that I think it's really going to overtake with the majority.
I definitely see more than half. I don't know that I'd say more than 75% is going to go. We have a public cloud customer study coming out. We just got the data back on, and I was looking through it today actually, and I think one of the laggards still in terms of public cloud application adoption is still ERP. I think that's going to be one of the biggest barriers for this kind of subscription flip. I think CRM, HR, productivity, that all kind of flips really quick, and I think that's going to have a larger percentage in terms of subscription to license. I think ERP, especially for some of the large manufacturing firms, is going to be a harder sell in that regard, and I think that will take a longer time and prohibit some of the higher percentages.
And and then there's also, you have to think of these sort of the Adobes and Oracles who are really bringing forth these huge marketing clouds and all that comes with that sort of supplements the whole CRM idea. I think that's also just what can be done with IoT and all the data that's emerging and all the applications that are going to come out to take advantage of all that data. I think a lot of those will be based in the cloud just because that's where the data is going to be located as well.
Yeah, to tie in, to maybe answer a little bit the last question as we get to the top of the hour is what will be the price points on custom ordered converged infrastructure? If you think of the Dell ordering system, I'm speaking Dell EMC, I'm out a couple of years, but if you think of the way you could custom build a laptop and they could manufacture a custom order, kind of like Burger King, when you have it your way, if you can add those reference architectures to plug and play different processors or different storage configurations depending on the workload that's optimized to these specific workloads, and if the price points are down low enough and they're sort of small or maybe large pizza boxes or small refrigerator-sized cabinets that are needed, and you can just sort of click on a set of menus and then get it built and shipped to you within a week, maybe it'll boomerang back because it'll be easier to control from a security and compliance standpoint. So there's always some disruptive factor that you can't take a look at that can change these things. That's one of the few things I've learned in the years I've been here is whenever you think you know what the industry's going to do, there's something that will come along and cause you to have to rethink everything you think you know. That's why we hope these webinars are valuable. As I said on the way out, we ask you to rate it and offer comments or critiques. We are eager to hear what you have to say, both positively or negatively, so we can improve upon the product the next time we come before you. But thank you for your time, and with that, I'll turn it back to Justin.
All right. Well, I'd like to thank Geoff, Meaghan, and Kelsey for your time today, and thank you, everyone, for your time with us. So you can follow our analysts as well as TBR on social media here, and please feel free to check out our YouTube page for our previously aired webinars. As a reminder, I'll be following up with all of you via email tomorrow with the link for today's recording as well as with the slides. And finally, if you have any questions about our application software benchmark, please reach out to myself or one of the analysts. We're always here to answer questions. So we'll leave the chat function open for another minute to people ask any last-minute questions. Otherwise, thanks for attending and have a great afternoon.